most people can't just sit home and watch a ticker all day. So if you missed it, here's a recap of the key things that you need to know. The Dow fell 879 points. It's now lost nearly 2,000 points in just 2 days. The 10-year yield crumbling to 1.34%. That is its lowest level ever, literally going back more than a century. The so-called fear gauge, the VIX, moving higher. And perhaps the most shocking stats of all, only 6 S&P 500 companies are higher this week. 3 of them are coronavirus-related, companies looking for a solution, and, of course, Clorox, for obvious reasons. More than 100 stocks are down more than 5% in the S&P 500. But if you believe that we have now come too far, too fast to the downside, we have got a way to play a bounce, if it happens, using options. Mike Khouw in San Francisco with your options action.
Yeah, so, yesterday we were talking about ways you could protect your portfolio by buying puts or put spreads. Today we're going to be taking a look at some ways that you might look for opportunities in stocks that you think might be oversold or might represent some value. I would point out that in situations like this, where much remains unknown, you don't want to run out and catch a falling knife. So we're not advocating necessarily going out and either buying stocks with whatever excess cash you have or using any leverage to do so. The other thing I would point out, though, is that in some ways the decline has been fairly orderly, fairly steady, not huge gaps down, but fairly orderly decline. The one other point I would make is try to avoid double exposure. So if you're going to look to do things like sell puts because premiums are elevated, don't do so in companies that might be exposed to a great deal of risk. Examples of that would be travel, airlines, and energy stocks. So I was taking a look at Microsoft, some ways that we could take advantage of the fact that volatility is a little bit higher. One of the ways that you could do this if you already own the stock and are thinking that you want to have more exposure to the upside but don't want more exposure to the downside is using a 1x2 call spread. Specifically, I was looking at April, the 175, 185 1x2 call spread. In this trade, you would buy the 175 calls. Those were trading for a little over $5 and then sell 2 of the 185s for about $2.15. Net, you're spending about 95 cents, so a relatively small percentage of the current stock price to make that bet. Really, all you're doing is trading off the upside above 195, and you get incremental exposure up above 175. That makes a lot of sense because the all-time high in Microsoft is 190. Hard to see how we're going to get there in less than 2 months. Another thing you could do if you don't already own the stock is something called a call spread risk reversal. In this situation, I was looking at selling the 155 puts and buying the 175 calls and selling the 185 calls. You can do that for even money. Now, here's the situation. You're going to get exposure to Microsoft from 175 to 185 on the upside, but you're not going to be forced to own it unless it falls down to 155, and that represents a better than 20% decline from the peaks that we saw not that long ago. So it's a way where you can get exposure to the upside without going out and buying the stock right here. And you're taking advantage of the fact that premiums are elevated. In some of those higher risk areas, though, the higher premiums are deserved. You might just want to buy calls if you're looking to make bullish bets there.
All right, Mike Khouw in San Francisco. Mike, thank you very much. Dan, your take on that strategy.
Yeah, so he offered 2 different ways to do it. I mean, the put sale one is one in a market like this. It can be very complicated for people. The notion that they're selling a downside put and maybe having the stock whoosh through that price if you had a big downdraft, really it's not too different than owning the stock and having that downdraft. And on the flip side, I think that Mike's 1x2 call spread, to add leverage and yield to an existing position, especially in a name like Microsoft, where implied volatility, the price of options is so elevated, makes a lot of sense. But again, fast markets, doing a lot of legs, it's kind of complicated for most people. I just think in general, look to kind of take in some expensive premium. That could be as easy as overwriting a stock. You own 100 shares of stock, you sell 1 out of the money call, and you have a band in which you're going to take some yield in if the stock is below that short call strike.
Do you think that's too complicated?
Well,
it's an advanced strategy.
I mean,
right?
Listen, there's a whole show Friday at 5:30.
It's called Options Action. Tremendous show.
Mike.
But can I, because Dan and what these guys do in Options Action, actually, they make it very understandable. But I will just say simply, if you have puts on, you have 2 days of vol like we have, what I typically do is I tend to roll those puts out. These are moments you've waited for when you had that protection, especially when you bought Qs 5% out of the money and whatnot. So to try to hold it for another vol spike up to 40, look, history says we don't get that. History says 2 days in a row of 95% down days are extraordinary by any measure. And that's an opportunity as someone that holds puts to roll these out, to take some profits and move these down the line.